Our business model is to issue the credit. So we're selling public credit like STRC and STRD, STRF, and we've sold about $8 billion of that public credit. So we will issue billions, then tens of billions of dollars of public credit, and our Bitcoin is the collateral backing that credit. So that's our business. I think the formation of bank credit networks around Bitcoin is very auspicious. It's very good for the asset class. If banks would not give you a loan on real estate, your real estate values would be lower. And if banks were unwilling to give a loan on a stock portfolio, then that would impair a lot of people that want to invest in stocks. The banks are moving into offering credit on digital assets and especially on Bitcoin. That will be good for the banks. That will be good for Bitcoin. And it's merely an acknowledgement that there's $2 trillion of wealth that is unbanked right now. And this is the banks beginning to move into this new asset class and provide banking services to the $2 trillion of holders.
The world's largest crypto asset is breaking free from its traditional four-year rhythm, signaling a new phase of institutional dominance. Michael Saylor offers a sharp, structural view of Bitcoin's current market dynamics, emphasizing that the asset has moved far beyond the simplistic four-year halving narrative. With Bitcoin now trading between $50 to $100 billion daily, the next halving's $20 million reduction in supply carries minimal influence compared to the scale of institutional liquidity entering the market. The real catalysts, as highlighted through his analysis, are the expanding credit conditions, the rapid growth of derivatives markets, and the regulatory shift that has opened the doors for traditional financial institutions. The surge in IBIT's open interest, from $10 billion to $50 billion within weeks, illustrates how Wall Street demand now outweighs the halving's impact by orders of magnitude. Saylor's observations extend into corporate strategy as well, noting the advantages companies gain by holding Bitcoin as digital capital. MicroStrategy's evolution into the world's largest issuer of Bitcoin-backed digital credit signals a broader trend that few companies have yet to adopt but many may soon follow. Strong regulatory support in 2025, combined with fair value accounting reforms, has created a favorable environment for public companies to treat Bitcoin as a high-growth balance sheet asset. Even as Bitcoin experiences a 20% correction from its recent peak, the structural backdrop, rising institutional adoption, improved banking guidance, and upgraded collateral treatment, positions the asset within a deeper, accelerating integration into global finance. As Bitcoin accelerates into its next institutional era, the conversation is only getting started. Drop your thoughts in the comments, share this analysis, and subscribe for more market insights.
Yeah, I think that the four-year cycles are based on the Bitcoin halving, and the Bitcoin halving was really important for the first 12 years of the asset because we were cutting, the amount of Bitcoin that was being cut from the supply was very material, relative to the demand in the market. But right now you're seeing days when Bitcoin trades 50 billion or $100 billion in a single day. The total amount of the halving in the next halving is going to be 225 Bitcoin. So 225 Bitcoin times even 100,000 a coin is it's $20 million a day is the impact of the halving. And so $20 million isn't the first order impact on a $50 billion a day liquidity. It's not even a second order impact. It's probably a third order issue. The primary drivers of Bitcoin right now are the structural developments in the market. For example, if the banks extend $50 billion worth of credit, right, that dwarfs 20 million a day in the halving. And then when the SEC loosened the restrictions on derivatives trading on IBIT, the open interest in IBIT went from 10 billion to 50 billion in a few weeks. So you're talking about tens of billions of dollars of demand for the asset based upon the embrace of the traditional finance establishment. And so the asset class is being driven by the structure of support in the banking industry and in finance, and a few regulatory changes that are actually enhancing that. Generally, I'm a big proponent of any company holding Bitcoin as digital capital on its balance sheet. I think that's good for the company, and that's good for Bitcoin, that's good for the crypto economy. Our business has evolved from a company that simply owns Bitcoin to a company that issues digital credit against the underlying Bitcoin. So today we're the largest issuer of digital credit in the world. If thousands or tens of thousands of other companies buy Bitcoin, that will be good for Bitcoin and good for our business. So it's helpful. Out of those 250 crypto asset companies or crypto treasury companies, only a couple are in the business of issuing digital credit. Examples would be Strive, that issued a treasury credit instrument about a month ago, and then Metaplanet, the biggest Bitcoin holder in Japan, that actually just issued their first digital credit instrument. So there's 3 of us that are in the digital credit market. There's probably 200 to 300 that are holders of crypto assets. It's all good for the crypto economy. They'll all benefit. But the exciting thing in the market right now is digital credit. Before November of last year, before the red sweep, there was a lot of uncertainty over the asset class. And so I think a lot of publicly traded companies were afraid to go into space. We have a very supportive administration. The president has designated Bitcoin as digital gold. The Secretary of the Treasury has said we want to be the crypto capital of the world. Donald Trump said we want to be a Bitcoin superpower. So we're the first year of institutional adoption. And in 2025, you got the support of the SEC, the support of the CFTC, the support of the Secretary of the Treasury, the support of the President of the United States. And so normally public companies are very risk averse. And with all of those supportive moves by the administration, combined with the accounting profession rolling out fair value accounting, which was a very big deal. Fair value accounting means that when you generate gains, you're allowed to mark them up on your balance sheet. And before that point, you could only take losses. You could never take gains. So the accounting was reformed, and the regulators began supporting the asset in the year 2025. And I think that once those 2 things happened, it became pretty clear that it gave a structural competitive advantage to a public company to have Bitcoin on their balance sheet, because Bitcoin has been growing 50% a year for the past 5 years. And so all things considered, if you're buying Bitcoin, you're buying the world's dominant digital monetary network growing 50% a year. And the alternative would be to hold something growing 5% a year.
The most transformative shift in today's financial system isn't happening on Wall Street. It's unfolding in Bitcoin-powered credit networks. Michael Saylor highlights a pivotal transition as public companies increasingly hold digital assets, especially Bitcoin, on their balance sheets. He outlines a structural shift in global finance where Bitcoin emerges as a core form of digital capital, competing not with currencies but with long-term stores of value such as gold, equities, and real estate. The deeper transformation lies in the rise of digital credit, with Bitcoin-powered instruments offering yields far above traditional benchmarks, creating strong incentives for savers and positioning digital credit as a rapidly expanding financial category. Saylor distinguishes between 2 hemispheres of the digital asset economy: digital capital, dominated by Bitcoin with digital credit as its flagship application, and digital finance, encompassing tokenized currencies, brands, and securities, supported by a pro-crypto regulatory environment. MicroStrategy has already issued over $8 billion in Bitcoin-backed public credit, with demand expected to scale into the tens of billions. This momentum coincides with banks beginning to offer loans and services against digital assets, unlocking an estimated $2 trillion in previously unbanked crypto wealth. MicroStrategy's purchase of 8,178 additional Bitcoins, bringing its total to 649,870, reinforces this strategy, even as JP Morgan's sale of a quarter of its MicroStrategy holdings sparks debate in the Bitcoin community over timing and potential market impact. Let's get back to the interview.
I think that generally public companies will start to buy more digital assets and hold more digital assets on their balance sheet. And I think that Bitcoin adoption is going to spread, and that will be good for Bitcoin, and that will be good for those companies. I think the real story going forward is going to be digital credit. If you think about the perfect product is a bank account that pays you 10% when the money market's offering you 4%. And so if you can offer people 600 to 800 basis points of additional yield over the risk-free rate, whether it's in the euro, the yen, or the dollar, then everybody's reaction is, yeah, I want that. What's the catch? And so I think that the real interesting idea is that digital capital, which is what Bitcoin is powering digital credit, and digital credit is 2 to 4 times more compelling than traditional credit instruments for people that want fixed income. There are 2 hemispheres to the digital assets industry. One side of the assets industry is based on Bitcoin. It's digital capital, and the killer application is digital credit, a bank account that pays you 10%. Okay, my company's strategy is on that side of the business. We're just offering credit instruments. If what you want is to hold digital capital, digital gold, and you want to hold it forever, or if what you want is to invest in digital credit, you want that kind of amplified exposure, you would buy our equity. The other half of the digital assets economy is digital finance. And the killer application of digital finance is tokenized currencies like stablecoin, or tokenized securities, or tokenized memes, or tokenized brands, or capital raising, et cetera. And that tends to have exploded over the past 12 months, because a very supportive crypto administration has encouraged all of those things to grow. So if what you want to do is invest in digital finance, you would have to decide which of those networks you think is going to be the winner, and you would do that's a tech investment. But if you're more of a credit investor or a capital investor, then you would want to invest in digital capital or a company like mine. The value proposition of Bitcoin is digital capital. It's someone that wants to store their value for the next 30 years. So if you think about it, you don't know of any billionaires that are going to sell everything they own to buy US dollars and put it in a safe. So you don't really have currency. Currency is the dollar competing with capital. Stablecoins are digital currency. It's a different industry. Bitcoin is digital capital. Bitcoin is competing with gold. It's competing with real estate. It's competing with public equity, your Mag 7 stocks or your S&P index, or private equity. And people that have always owned those capital assets in the 20th century, and they're thinking they want to own digital capital. Stable coins, on the other hand, they're competing with traditional credit card networks or traditional banking networks, and they're offering people with digital payments technology all around the world. Ultimately, the big winner in the stablecoin movement is going to be the US dollar, because what it means is that every foreigner will be able to use dollars instead of using pesos, bolivars, rubles, CNY, euros, any African currency, the rand, etc. So the dollar is the winner, the US is the winner, and then the technologists that enable and host those digital dollars, are going to be successful companies. I think it will continue progressively. I think that there are very positive moves. There's good positive guidance from the banking regulators right now, directing banks to begin to support Bitcoin. There are really good moves from the banks. They've all announced they're going to begin to custody and hold Bitcoin. That helps. I think there's some positive guidance coming from Basel and the Basel working group, that they will start to upgrade the collateral value of Bitcoin for bank balance sheets. That will be very helpful. So I think that all of those things will generally accelerate institutional adoption. Every single month that goes by, there are more large institutions that come out in favor of digital assets and Bitcoin in particular. And every single time one of them announces that catalyzes another to consider doing this.
The ongoing evolution of Bitcoin highlights a clear shift from speculative narratives to structural adoption, driven by both corporate strategy and institutional demand. Daily trading volumes in the tens of billions dwarf the impact of traditional halving events, signaling that liquidity, credit expansion, and regulatory support now play dominant roles in price formation. Corporate balance sheets are increasingly integrating Bitcoin as a form of digital capital, while the emergence of Bitcoin-backed digital credit offers yields substantially above traditional financial instruments, creating a new, high-growth market segment. At the same time, banks entering the ecosystem with loans and services against digital assets validate Bitcoin's role as collateral and unlock trillions in previously unbanked crypto wealth. This combination of institutional integration, corporate adoption, and financial innovation positions Bitcoin not merely as a store of value but as a foundational asset within a rapidly maturing global financial infrastructure. With institutional adoption and digital credit reshaping Bitcoin's role in global finance, how will corporate balance sheets and traditional banks adapt in the next 5 years? Bitcoin's transformation into a cornerstone of digital finance is accelerating. Join the discussion in the comments, share this analysis with fellow investors, and subscribe to stay updated on the latest market insights.